So just to put it into context, Bank of Canada moved 150. Our cost of funds moved up and down 1,000.
Earlier in this year, rates were up and down every single day. It was very difficult to effectively tell your client what rate to expect. A mortgage broker trying to pre-approve a client and give them a price point to go shopping. It was very difficult. We had a lot of our agents calling us pretty much every day, like, hey, I found out broker Joe got this rate and I'm getting this rate. And it was like, well, he got that rate quoted to him 3 days ago.
The best way to understand pricing is to start with understanding, how banks think about their cost of funds. Banks, unlike, some other participants in the market, like they have a lot of different sources of funding. They have deposits, covered bonds, the NHA MBS program, and they have their own ability to issue bonds to raise funds. And they also have a lot of different lending that they do. All banks have to have some way of bringing order to the cost of funds and transferring that, and they call it transfer pricing. A lot of people talk about banks' cost of funds. They say, watch the bond market. That's true. We call it the base rate. It's not exactly the bond market. It's a derivative of the bond market. The second part of the cost of funds, which we call liquidity premium. Most banks have something similar to this, by the way. The point is that there's two components. And the liquidity premium is something that represents the additional risk the market attributes to a bank raising funds in a market versus, let's say, the government of Canada. And when you add the two together, you get overall cost of funds. The market-based rate is hedgeable. When in a 120-day rate commitment environment, it's very important if you're making a rate commitment today, by the time that deal funds, you need to be protected that your cost of funds is still going to be the same or close to the same as when you made that rate commitment. And there's a cost to hedging, which is built in. The liquidity premium component, if you will, of the cost of funds is not hedgeable. There's an embedded risk in there that in that 120-day rate commitment period, if that liquidity premium goes up, your margin gets squeezed. We had a very volatile year. I went back and I took the absolute value of rate movements on a daily basis and added them up. Total rate movement in the year was 1,000 basis points.
Holy smokes.
And you think of a 250 business day a year, that's like 4 basis points a day. Bank of Canada moved their rate 150 basis points. So just to put it into context, Bank of Canada moved 150. Our cost of funds moved up and down 1,000.
It's insane.
If I go back to that 1,000 basis points of volatility, 2/3 of that happened in the first half of the year. Sort of the last couple of months, we've seen the overall cost of funds come down, a couple of central bank rate cuts in there too. So going back to your point about the craziness at the beginning of the year, like this was why, right? Like we're trying to manage like all the volatility that was going on literally a daily basis. It was tough for everybody to manage through that.